Okay, so FAC3704 is somewhat similar or builds on from 2602. But in 2602, if you recall, we really only looked at subsidiaries. Yeah. So 2602, we looked at subsidiaries. We didn't look at anything else, although we did look at two main things, or three really. We looked at cash flows, but I think we didn't look at group cash flows. We looked at just normal cash flows. And I'm just going to put that in there because now we're actually going to look at group cash flows. So we looked at cash flows. We looked at IFRS 3. Do you remember IFRS 3, which is the acquisition, the on-AC? Yeah? And we looked at IFRS 10 and IAS 27, which is the consolidation. Yeah, so basically in second year, we spent some time looking at this on AC, calc, and then we looked at the actual process of consolidation. How do we consolidate? And we looked at a couple of things. We looked at all the intercompanies. We looked at what to do with dividends. We looked at what to do when there's preference share capital. Do you remember all that? And then we lastly looked at cash flows. In 3704, we're going to look again at this, and we're going to revise this again. 3704, when we look at subsidiaries, we go one step further, and we look at vertical subsidiaries, where it looks like that. Yeah? Because if we have control, if the parent has control of the sub, and the sub has control of another sub, then effectively the parent controls all the subs underneath, isn't it? So we're going to look at this, which is vertical subsidiaries. And we're also going to look where we have multiple subsidiaries, horizontal ones, because I think in second year we only looked at the case of one subsidiary at a time. Okay, so what we're going to have now is we're going to have multiple subsidiaries. So in the first lecture, we're going to again look at IFRS 3. We then in the second lecture going to look at the consolidation process and horizontal subsidiaries, and in the third lecture, vertical ones. We are also going to look at 3704, in 3704, at other levels of control, because subsidiaries was control, isn't it? We looked at that definition, do you remember, of control. We're going to look at associates, and associates is where we have not got control, but we have influence. Yeah. We're also going to look at joint ventures or joint ops, which is where we have joint control. So lecture 1, 2, 3, 4, 5. Yeah, we're going to look at those things which we didn't look at second year at all. Then we're going to take a deep breath, because then we're going to look at probably the most important, or one of the most important aspects of FAC3704, which is changes in control. We're going to look at what happens when we sell a subsidiary. What happens when we sell partially our ownership of a subsidiary, and then we're left with some influence maybe, or we're left with just an investment. What happens when we have an associate and then we buy more shares and it becomes a subsidiary? Yeah, so we're going to look at changes, and we're going to spend 3 more or 4 more weeks looking at changes. Yeah. We're going to look at changes resulting from more acquisitions. We're going to look at changes resulting from disposals. We're also going to look at changes resulting from when the parent issues more shares. Do you agree? If the parent issues shares to a new shareholder, then your shareholding is affected. So we're going to look at those, at changes. So we're going to spend quite a few weeks looking at changes. And then right at the end, we're going to land on cash flows again. But this time we're going to land on cash flows, but this time our cash flows is going to be group cash flows. Group cash flows are not really that different. The technique is exactly the same as what we did when we did cash flows in second year. And students usually like it. Why? Because it's separate. So what will happen, if you remember second year, we sort of built all the time, isn't it? So here we're going to build for the first 3 lectures. Then we breathe, because that lecture is standalone and that one is standalone, because that's an associate. It's completely different to subsidiaries. That's joint control. It's completely different to subsidiaries and associates. But then when we come back here, we then are back to everything merged, because we're looking at when associates become subsidiaries, when subsidiaries become associates. We're going back and forward like that. And then at the end, again, we breathe, because then it's just cash flows. So even if you don't remember anything, you can still do a cash flow. Yeah? All right, so that's FAC3704. We're going to try and finish. I'm going to try and finish in about 9 to 10 weeks, and then to have some time at the end to do past exam questions. As we go, we're going to try and do assignments. There are 2. Assignment 1 is multiple choice. Sometimes it's the other way around. Assignment 2 is a written assignment where you actually have to prepare sets of financials. They are... the assignments are in Title Letter 101. Sometimes they're not, but for this module, they are there. And we are today going to do a little bit of assignment 1 and a little bit of assignment 2, because we're going to do the ONAC piece for both of the assignments. Okay, so let's just do a re-look then from what we know from second year of IFRS 3. IFRS 3, if you don't remember, is the statement that deals with the transaction. Not many of our statements deal with transactions. Yeah, most of our statements deal with presentation and disclosure. They deal with how do we put it into the financials, how do we disclose it. They don't really deal, and they deal with balances, assets, isn't it, and liabilities and revenue. They don't really deal with the transaction. This IFRS 3 deals with the transaction, and that transaction is a transaction where there is an acquirer, which is a parent, and the acquirer gains control of the acquiree. And control is defined in IFRS 10. IFRS 10 defines control. So we're going to look at this definition of control next week when we look at IFRS 10 and IAS 27. So for today, we're just going to say we acquire control of the acquiree. What's important to look for is the date. And in order for us to do IFRS 3 accounting, acquisition accounting it's called, it's important that we are able to identify all of these elements. So it's important that we are able to identify an acquirer, an acquiree, that we're able to identify whether there's control, and that we're able to identify a date. And without those, there is no IFRS 3 transaction. Yeah? If we cannot identify those, then we don't have an IFRS 3 transaction. But once we've identified those, and at honors level, there can sometimes be like 20, 30 mark questions just on this. Is there an acquirer? Is there an acquiree? Who is acquiring? Because sometimes there are such complicated transactions and deals that it becomes hard to figure out who's buying who, and is there control or isn't there control, isn't it, and what kind of control is it, etc. All right, so if we go back to IFRS 3 accounting, then there are 4 steps which I'm sure you remember from second year, right? Step 1 is over here. It's to identify the assets and liabilities acquired. Yeah? So the acquirer is buying the assets and liabilities of the acquiree. So step 1 is to identify the fair value of assets and liabilities acquired. Yeah? So you remember from second year that when we are looking at this concept, which is fair value, that it means that there are adjustments that are sometimes made to the books, to the carrying amounts, isn't it, of the assets and liabilities as they stand. Okay, so we make these adjustments, and at third year level, we also adjust tax. So you know that when we do this step 1, and I'm just going to make my pen a bit thinner so I can just... when we do this step 1, we start with reserves, with equity. Yeah? Because equity equals assets minus liabilities. You remember that, isn't it? So step 1 starts with share capital, retained earnings, reval, mark to market of the subsidiary. Yeah? Of the subsidiary. So whatever equity the subsidiary has on acquisition, that's what we start with. And then we make our adjustments to that number. So if we're going to revalue property, plant, PPE, receivables, inventory, if we're going to provide for contingent liabilities, if we're going to bring in some intangibles, let's assume, you remember from when we did FAC3704, internally generated intangibles, a company is not allowed to recognize, isn't it? But if you're buying a company like Coca-Cola, you're going to pay for that brand. We must recognize the brand, isn't it? So there will be intangibles that aren't recognized in the assets and liabilities of the company that we will bring in. There will be liabilities that perhaps haven't been recognized that we need to bring in, like contingent liabilities. There will be adjustments to fair value. For each one of those, we must remember to put in a tax adjustment. Okay, that's something we hadn't done at second year level because we hadn't done FAC 3701. But you've done it. You know about tax and deferred tax. So whenever we make an adjustment now at third year level, we adjust for tax. And importantly, when we are adjusting the value of land, we adjust CGT. Yeah? So most of the time, our adjustments... Most of the time, I'm just going to write here, CGT. Most of the time, the adjustments are straight 28, but we must be very careful. Sometimes it's 0. So they may say to you, for example, that we have to provide for retrenchments because we're retrenching employees and we won't get a tax deduction. Or we have to provide for a court case that we think we're going to lose, and there won't be a tax deduction for that. Then there's no tax. Sometimes it's CGT. When is it CGT? When it's land. Yeah? So predominantly we're talking about when it's land, and you must remember that you must put it in at the CGT rate, not at the normal tax rate. Okay, so that's step 1. What else do I need to tell you about step 1? There's a clause. It's a 12-month clause. And it says that you have 12 months to finalize numbers, fair values, yeah? 12 months to finalize fair values. What that means is that we may do interim accounting, do interim calculations, and then find that we get a valuation on a property or that a court case gets finalized, and we then have a different value. And it affects goodwill. Yeah? When we do goodwill, I'll come back to that and I'll do a little star and a link because it affects goodwill. So step 1 is the fair values of assets and liabilities acquired. We start with the equity of the subsidiary, and then we adjust for all the adjustments that they give us in the question, and we remember tax for each one. The way I like to do it, I do all the equity, then I put the adjustments in one by one. Adjustment, tax, adjustment, tax, adjustment, tax. Sometimes in solutions what you'll see is adjustment, 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 one number for tax. But if you just force yourself, adjust tax, then you won't forget. Okay. Step 2 is then to look at what am I paying? Consideration paid. Consideration paid, and I don't know, I can't remember if this is something that we talked about at second year level. But consideration paid for an acquisition can be and is mostly cash, but can also be assets, can also be shares. Yeah? can also even be a contingent consideration, a later consideration that I'm going to pay based on something happening. How do I value these items? Cash, I value at PV. So just be careful here. They sometimes will say to you, you're going to buy the subsidiary, you're going to pay $1 million today and $1 million every year for 3 years. You have to PV all of that, isn't it, to get it to today. Assets is at fair value. So it's not what we're carrying them in the books at, it's what they're worth if I give an asset to the shareholders. Shares, if I issue shares, shares are also at fair value on the date of the acquisition. Not the date that I issue the shares, the date of the acquisition. On the day that control passed, on that day, what was the share price? It might be that I only give the shares physically later, but that doesn't matter. It's not when I give it. Hey? It's the date that we agreed how many shares I was going to give. Okay? Remember also that if I give shares as payment for cash, then it is actually considered cash. So if we say, I'm going to give you R1 million worth of shares, then you're giving R1 million, isn't it? Then it's not the fair value of the shares, it's R1 million, because then the number of shares changes. All right? And then lastly, contingent liabilities are also measured at fair value. I determine, and that fair value will be given in the question, I determine what the payment might be, and I determine what the probabilities are. Yeah? So I do a probability calc, and I do an expected value, and then I might even PV it. So the contingency might be something like, if you meet certain sales targets, so I'm buying your company, you're promising me that this company is going to make this much turnover. And then I say to you, look, I don't really believe it, but let's do this. If I do meet that, I'll pay you more. Right? So we do a deal. So that's what those contingent payments are. They're usually based on profit targets or sales targets being met in the future, and then it's some payment that will happen in the future. It might be cash, it might be more shares. But I need to do acquisition accounting today. So what I'm going to do today is I'm going to say, what is the probability that I'm going to pay what amount? And I do a probability calc, and which is the fair value, and then I PV that, and that's the amount that goes in. For third year level, it's given. If you have a contingent, it will be given. Okay, so we have step 1, which is assets and liabilities, and we have step 2, which is consideration paid. We then, let me just put it on a different page. We then have step 3, and there's my parent, there's my sub. Step 3, which is somewhere, no, let's put step 3 to the side over here, is somewhere to the side over here, is to determine NCI. Yeah, because there's this other shareholder. He owns some of the shares. When I'm buying the subsidiary, I'm not buying all of it. Maybe I'm buying 80%. And there's this shareholder, this NCI, who owns the remaining 20. And step 3 is to value NCI. Now, at second year level, we always valued NCI at percentage NAV, proportionate net asset value. Do you remember that? Proportionate net asset value. But actually, the statement allows you to do percentage NAV or fair value. What is fair value? It's the value of his shares, isn't it? Value of shares. So they may say to you, at the date of acquisition, the share price was 10 Rand. You go and you see how many shares he had at 10 Rand, that's the fair value. Yeah? When I use percentage NAV, the NCI has no goodwill. Do you remember that we didn't have goodwill for the NCI? Do you remember that in second year? Yeah? So when we do this, NCI has no goodwill. Why? I'm measuring him at the value of the assets and liabilities, isn't it? That's all. So there is no goodwill for the NCI. It's also therefore called the partial goodwill method, because only the parent has goodwill. But when I measure it at fair value, the NCI has goodwill. And so this is called the full goodwill method. So step 3, which is to measure the NCI, the non-controlling interest at acquisition date, allows you, IFRS 3 allows you 2 options, 2 policies. 1, to measure NCI at proportionate net asset value, percentage of NAV, or, as is sometimes called, the partial goodwill method, in which case we just take the value we had in step 1 and we give NCI their percentage. Yeah? It also allows you to use fair value. In that case, you're not going to use that value of assets and liabilities. You're going to look at what are his shares actually worth. What is his share worth? To do that, either it's a given or they give you a share price on that date. So we look at the share price on that date. The value of that share is the fair value. There is going to be a difference between these 2 numbers. Do you agree? There's going to be a difference between the percentage NAV and the fair value. This difference is this goodwill, isn't it? So the difference between NAV and fair value is what gives us the goodwill then. Yeah. Because then step 4 is the actual calculation of goodwill. Step 4. And do you remember the calculation? I'm going to show you the way that IFRS 3 likes to do this calculation, because later on when we do changes in ownership, we're going to come back to this calc. And if you remember step 4 looked something like this. Fair value of assets and liabilities less NCI is the fair value which is attributable to the parent. Do you remember that? And then I take off what was paid, and let me actually say consideration. Less consideration paid gave me goodwill if it landed up as a bracket at the end. Do you remember that from last year? So let's relook at this calc. I look at the value of the assets and liabilities that I'm acquiring. I take off what isn't mine, NCIs. It then leaves me with the fair value to the parent, attributable to the parent. Then I compare that with what the parent paid, and I'm left with goodwill. Yeah. Now, what happens with this step 4 at third year level, first of all, is that we look at the possibility that this number at the bottom here is not a minus, it's a plus. When I pay less than what I'm getting, in other words, I'm getting a value of 100 and I only pay 80, yeah, I land up with something called a bargain purchase. A bargain purchase. A bargain purchase is a credit. A credit. This credit is going to go to P&L. It's a gain on acquisition because I have acquired something that is worth more than what I paid for it. When I have goodwill, I have paid more than what something is worth. I say to myself, it's not that I've done a bad deal, it's just that there is goodwill attached, because the value of assets and liabilities as they stand is less than what I can make from these assets and liabilities, if you remember from when we do valuations, isn't it, in MAC? So that's why I call that goodwill. But when I pay less, what I say is that I have a bargain. Yeah? Yeah, and that bargain purchase, lands up as a credit in my P&L, in other income, in the year of acquisition. In future years, where does it land up? In retained earnings, isn't it? So in future years, it lands up in opening retained earnings. In the year of acquisition, it lands up in P&L, in other income. But then in future years, when I do this calculation and I'm doing the journal can't go to P&L every year, isn't it? Because I do this ONAC journal every year, isn't it? Remember that ONAC journal that we do that lands up with the Goodwill? Now your ONAC journal is going to possibly land up with a bargain, which is a credit to balance the journal. That credit cannot go to P&L every year. Can only go to P&L once in the year of the transaction. In future years, it must go to retained earnings. So that's the first thing to remember here. And then the second thing is that when we do this step 4, there are two possibilities for numbers. The one is NCI measured at proportionate, and the other one is NCI measured at fair value. So I want to show you, if you've got your study guides, an example that shows both. So I'm looking at I'm looking at example 1.8. It's on page 36. Okay, so it says, on 1 April 01, no, that isn't it. Sorry, that's the adjustment. No, I'm lying to you. I know that one of my, oh, it's here, 1.6. Sorry for that. Example 1.6. It's not on page 36, it's on page 32. Okay, so it says, A acquired control with the acquisition of 80% in B for 1.1 million on the 1st of January 08. So as I like to do it, I like to draw the picture so that we can see everything exactly as and when it happened. 1 Jan 08, I bought 80% and I paid 1.1 million. On this date, the share capital of B was 200 and retained earnings was 800. So share capital 200, retained earnings 800. So it was R1 million, the fair value. The fair value of assets of B was R1 million. Okay, so there's no adjustments to be made to the fair value. And then they also say to you that the market value of the shares at that date was R7 a share. So on that date, it was R7 per share. Okay, so there are two possibilities with this NCI. Here's the NCI. He owns 20%, isn't it, of the shares. So there's two possibilities on how to treat this NCI and what number we're going to land up with as Goodwill. The first possibility is the way we always did it in second year, which is percentage NAV. So if I look at percentage NAV, then I start with fair value, assets and liabilities, $1 million. I'm going to just work in thousands. Then I say NCI is 20%, 200. I'm left with 800. I paid 1.1 million. I have Goodwill of 300. Easy, right? It's what we remember doing from second year. Okay. Now, at third year, they may say to you in the question that Unbelievable. Okay, they may say to you in the question at third year level that NCI is to be measured at fair value. So if I measured NCI at fair value, they said to you in the question that they have 200,000 shares. If he owns 20%, he owns 40,000 shares. Do you agree? Then the fair value at 7 Rand a share is actually 280,000 Rand, isn't it? Let me just make sure that I'm adding properly. 220%, 7 Rand a share, 280,000 Rand. So if I had to do the calculation, assuming fair value, then the calculation looks like this. Fair value of assets and liabilities, still $1 million. NCI is 280. So therefore, what I've acquired is actually only 720. Yeah? I paid 1,100. So there's goodwill of 380. In the first instance, NCI is going to go into equity at a balance of 200,000 Rand on acquisition, and I'm going to put goodwill of 300,000 Rand on acquisition into my balance sheet. In the second scenario, NCI will go in at 280, and I'm going to put goodwill of 380 in my balance sheet. For now, you don't need to worry about anything else. At some later stage, when we look at changes in ownership, and when we look at the fact that maybe we're going to buy another 10% from the NCI at some date, we must be able to take this 380 and say 300 is the parent's goodwill. The other 80 is the NCI's goodwill. And you can see that 80 here. Yeah? Because when we are selling or buying shares later, we have to say, how much goodwill have I given up or lost because I've sold shares? Or how much goodwill has the NCI given me because they've sold me their shares? Do you understand? But for now, it's treated no differently to the way we treat the 300. We treat the 380 exactly the same. It goes into our balance sheet at 380. It gets assessed for impairment. And maybe that's the only thing that you do need to worry about with the two methods, is that when we do this method and there's an impairment of goodwill, then the NCI must also get a share of that impairment, isn't it? NCI gets share of impairment of goodwill. And in this case, I'm just going to put a star and say no, not. And it makes sense, isn't it? Because in the partial goodwill method, the NCI didn't have any goodwill. So if later on the goodwill is impaired, I don't give him a share of the impairment. Yeah? But if it's full goodwill, then the NCI does have a share of goodwill. So if later on the goodwill is impaired, he will get a share of it. Yeah? And it affects your calculation of the impairment of the share of profit since acquisition. We will look at it again when we do consolidations proper, but this is just something to remember. Yeah? So that's a couple of things that are different at third year level. Then if I can just go back and revise. Step 1, we have to worry about tax and CGT, and we have to worry about this 12 months to finalize, which I'm going to show you an example of now. Step 2, we might see assets or shares or contingent payments being given. We might see present valuing of cash that was given at a later date. Then step 3, we have the two options on how to calculate NCI at fair value or at percentage NAV, and it affects goodwill because over here he has goodwill, over here he does not. And then step 4, we seeing for the first time the possibility that we land up not with goodwill but with a bargain. And if we land up with a bargain, that bargain goes to retained earnings at beginning of year, or if it's in the current year, goes to P&L. All right, so example 1.6 showed you the differences, these two differences. Then example 1.8, which was the other one that I wanted you to look at today, just shows you what happens when we have a the 12-month period happening. So what they say to you in example 1.8 on page 36 is that they say to you that we purchased 75% in a company called Baden, and they've given us some information about their plant. And they say to you that Aiden decided to obtain an independent appraisal on the value of the plant, but the valuation was only finalized the 31st of August, and the year end is June. So if I did a timeline, what happened is this. Acquisition date was April. Our year end is June. And in August, we get a final valuation. So you can see the conundrum that we have a year end. So the fact that we have a year end means we have to produce financials and means that we have to work with interim numbers. Yeah. So what you can see happens here is that they initially decide to value the plant at 2 million rand. So as at this date, the plant was valued at 2 million rand, and because the plant was valued at 2 million rand, NCI is being measured at percentage NAV. You'll see there that you always have to look to see how they're measured. It says NCI is measured at percentage NAV. So NCI lands up being measured at, I don't know why it doesn't save. So NCI lands up being measured at 750, and we land up with goodwill of, because we paid more, we land up with goodwill of 50. So we do our financials as at that year end on that basis. Yeah, but then what happens is they say to you that since the independent appraisal was finalized within 12 months, it is within 12 months, right? We do a final valuation, and the final valuation comes out that the plant is actually valued at 1.8 million, not at 2 million. So it's valued at 200 less. That 200 less has an impact on NCI because NCI is measured at percentage NAV, isn't it? So NCI lands up only being 700, and it has an impact on goodwill because now we still paid the same amount for plant that's worth less, so goodwill goes up. Does it make sense to you? We still paid the same amount. We didn't pay less, but our plant is worth less, so it means that what we paid must have been more goodwill. Yeah, so goodwill goes up. And you'll see they've given you journals to adjust for that goodwill. And then what they also need to do is to adjust the depreciation on this plant, because we had revalued the plant on acquisition and now it's been valued at a different amount, so we have to go back and correct. Yeah. So we go back, we fix goodwill, and we fix the plant. And what we would also need to do at this stage is disclose. So in our financial statements, we need to do a note where we disclose this fact, although disclosure, which is covered in IFRS 12, is not really part of the syllabus for third year. But we would need to disclose that fact, that that's what's happened, and disclose the impact that it's had. Yeah? It's almost like an error, isn't it? Like we're fixing an error. The statement allows 12 months for this final valuation to be done, and it's very important that this valuation is the value of this plant as at that date, as at April. It has to be the value of the plant as it was in April. If such circumstances have changed, if the plant has changed, none of that should impact that final valuation. This isn't a way for us to take maybe an impairment on plant and then push it to goodwill. Yeah? This is just a way to finalize a valuation that should have been done if the world was perfect, we would have been able to do it on that day. Yeah, but it isn't perfect and we weren't able to. Okay, so that's the 12-month story. Okay. What else is there in this first chapter? There's a couple more things that I may as well touch on them because then I might forget to come back to them. The first of those things has to do with, do you remember what I always said to you was the very first acquisition journal, which is to reverse the mark-to-markets? Do you remember that? No. And I'm wondering if I should mention it now because it's not really IFRS 3. I don't think I will. I'll talk about it when I talk about consolidation. So I just want to point out to you one more example. It is example, it's not an example, it says illustration. It's on page 43, which has to do with cumdiv, buying shares cumdiv. Okay, so this is the scenario. Once again, let me draw a timeline for you. Let's assume that a dividend gets declared over here on this date. And the dividend is going to be paid over here on this date. Yeah? And the acquisition date falls in the middle. Okay? So what happens in this scenario is that when the dividend is paid, you are the shareholder. Do you agree? But the dividend had already been declared. So the person that should have received the dividend was the previous shareholder, the person you bought the shares from, isn't it? So what might happen in this scenario is that this acquisition price includes the dividend, payment for dividend. Do you agree? So this acquisition price might include a payment for a dividend. And if it does, we must just remember to remove it. So if you look at your example, the scenario that I've given you here on the board is illustration 2. They say to you, on the 20th of July, the parent purchased an investment in a subsidiary for 210,000 Rand. The subsidiary proposed a dividend on the 15th of July. So the subsidiary had proposed a dividend over here, 15 July, of 10,000 Rand. We, on the 20th of July, acquired shares, and the price that we paid was 10,000 Rand for the dividend plus 200 for the shares, because we're going to receive a dividend that was declared to the previous shareholder. So you'll see when we do the journals, we separate them. This is the consideration. This amount here is the consideration. This amount we don't account for. You'll see that they take it to debtors, and then when we receive the money, because we'll receive the money, isn't it? We just take it back out of debtors. So we just consider it as an advance. We gave them an advance. When we received it, it all clears in our books. Yeah. We also sometimes get the situation where a dividend is declared immediately after we buy shares. If that's the case, well, it's too bad, isn't it? Whatever we paid is what we paid. We didn't pay for dividend, we paid for shares. So we just need to be careful with dates and what they actually say to you in the question about how to treat these cum divs. Okay, so that's that example. All right. So that is, in essence, then IFRS 3, which is this first picture that we looked at with the 4 steps. You'll see that in your study guide, they don't talk about 4 steps. They talk about, I think it's 7 steps, something like that. But it's just because the initial steps seem to be much more. So they've got 8 steps. Step 1 is the acquirer, identifying the acquirer. It's on page 15. Then step 2 is the date. Step 3 is identifying what we gave, and step 4 is measuring it. Okay, it's just more steps. Then step 5 is identifying the assets and liabilities. Step 6 is the NCI. Step 7 is goodwill or bargain, and then step 8 is these adjustments, if there are adjustments that are made. But for me, it's 4 steps, isn't it? What am I buying? What am I paid? What's NCI? What's goodwill? Yeah? All right. So, It's just a question of practicing some of these and seeing how putting in practice some of these things that are a bit different at third year level. So in your assignments then, as I said, assignment 1 is multiple choice. Just go to the end. Assignment 1 is multiple choice, and assignment 1, we're not going to be able to do it all today. We're going to be able to do question 1 and question 10. So, assignment 1, question 1 is Goodwill, and question 10 asks you what is NCI on acquisition date. NCI on AC. Okay, if you remember what is important to do is to draw your picture, who acquired who, when, how much, and when you're looking at assignment 1, we're only going to look at the bullets 1, 2, and 3. So if you look at additional information or paragraphs, rather, let me write here. Paragraphs 1, 2, and 3. Paragraph 1 tells you about the acquisition, what we acquired and when and what we paid. Bullet 2 or paragraph 2 tells us about fair values of some of the assets and liabilities. And then paragraph 3 tells us about preference shares. There's some preference shareholders. But it looks like there's no arrear dividends or anything like that on preference shares, so it doesn't look like there's any funnies to take into account. Yeah? It's only when there are the arrears, if you remember, isn't it, that we on AC have to split the retained earnings, if you remember that from second year. Okay, so paragraphs 1, 2, 3, question 1 and question 10 is what I want you to try to do. I'm going to go get some water to drink, and I'll be back.